We'll now take a little bit of a different tack, if you will, thinking about this decision and talk about some theories. So we're going to discuss the following theories here. Actually, the first four will be covered in this video. The others will be in the next video. But we want to talk about what does research say should be the answer, right? How should we approach this idea of gathering funds and how that affects the value of the company? So here we have two firms again, unlevered U, levered L. We see that the actual total cash flows for both companies is the same. Under the unlevered company, all of the money goes to the shareholder, but under the levered firm, that is split between the shareholders and debt holders. So a general theory might say that as long as the cash flows are the same, there shouldn't be any influence on value. So we have Modigliani and Miller, we mentioned them a little earlier, started this idea, these questions about how we should finance. And they said, well, what happens if we have a world that has no taxes, right? They have no transactional costs, no restrictions on short selling. There's no difference in how you can borrow and the rate that you pay. And what Modigliani and Miller prove say that, look, if the total cash flow to investors are equal, then if they're unequal, then arbitrage is possible unless the value of the firms are also equal, right? So if the cash flows are same, there has to be equal value, or we could trade and take advantage of that inequilibrium, if you will. Now, because free cash flows and the values between the firm are equal, we're going to assume here that their weighted average cost of capital are equal. So again, if you go back to our formula for the value of the firm, free cash flow divided by 1 plus the weighted average cost of capital, if the number in the bottom, if the numerator is the same and the denominator is the same, then the values ultimately have to be equal. Now, that's a little hard to imagine because we know in reality it doesn't seem right? This does not seem to be true. It doesn't seem like it would hold in reality. It won't, right? Think about these assumptions up here. None of those assumptions are true. But if we sterilize the world and say, what influence does borrowing have on the company if there are no taxes? There are no personal taxes. There's no corporate taxes. There are none. So let me give you a little example here. If the company wanted to give you $100 as a return, would you care whether they called it an interest or they called it dividends? Now remember, we live in this world where there are no taxes. So if they give you $100 in interest, you pay no taxes. You get $100. If they give you $100 in dividends, you get $100. There's no taxes. On the other coin, there's also no benefit to the company because there's no tax deduction because there are no taxes. So if there's no influence to anybody, if nobody cares, everybody's going to get what they get, it cannot possibly affect the stock price. Now, what we find as we release and limit or reduce some of these assumptions, we know we have corporate taxes, right? Obviously, know we're allowed to deduct taxes. So when we conduct taxes, less money goes to taxes and more money goes to investors. So they refer to this as being a tax shield. Tax shields are benefits. In fact, all deductions are tax shields because all deductions allow us to reduce the tax we pay to the government. That money then that we released from the government now goes to our owners. So if we now have this basic form, it says, look, the value of a levered company equals the value of an unlevered company plus the tax shield, T times D. That tells us then that every time the company borrows some money, the value of the company is going to go up. So again, the cash flow of the levered company equals the cash flow of the unlevered company, plus now we get this benefit. Here's the cash flow that actually goes to the investors from us borrowing money. So how does that affect the values? The value of the cash flows of the unlevered equals the value of the unlevered. The Medigli and Mantle show that the value of this R sub D, this value here, that is equal to this tax benefit we have up there. So again, our formula mathematically shows us that as companies borrow, value increases. So we have a horizontal line here, V sub U, basically says, look, doesn't matter how much debt you have, the value of the debt of the company will not change as long, just pick where you want to go. You can go anywhere and the value will not be different. But as we borrow money, it shows that every time you borrow money, that's D for debt, every time debt increases, because of the tax code, the value of the company will go up. So this would assume, or this implies, that companies should borrow as much money as they can. In fact, they should have 100% debt. Now, of course, we know the tax code changed. So how did this affect this overall theory? We know that the corporate tax rates fell. So the combined federal and state tax averaged around 40% prior to this. Now it's about 25%. So the tax shield has been substantially reduced. So the slope of the graph is lower. What we haven't been able to determine yet, because it's a little bit too close to the event, is it's kind of uncertain how the limits on interest expense, how is that going to impact this line? Because now we've put a little bit of a kink in the line so that the value at a certain point may not continue to rise as we borrow more and more money. Time will tell, and certainly research in the next 5, 10, 15 years will tell us the impact of this. The next thing we can look at then are personal taxes. My taxes that I pay as an investor have an influence on what I want to buy. So in our tax code, you may remember we've talked about this a couple of times. The taxes on debt as a person are higher than the taxes on dividends and capital gains. So investors really don't want interest income. They would rather have equity kinds of income. So corporate taxes favor debt financing because companies can deduct them, but they favor equity financing since there's a higher tax rate on that kind of income. So Miller, again, I'm fairly certain it's the same Miller from Medigli and Miller. Miller came up with some other research and basically devised this theory that says, again, the value of a levered company equals the value of unlevered. Now, you have to add the tax effect, but now we have three taxes. We have the corporate tax, T sub C is the corporate tax. We also have the shareholders tax, T sub S, and we have the tax we pay on debt. So now we have to try to figure, how does this affect the amount that we want to borrow? Well, kind of depends on the relationship of these numbers. But in general, we get the same kind of graph, if you will. The value of unlevered, again, that's our horizontal line. And this says 1 minus this amount. So it's less than 1. For every dollar you borrow, there is an influence on value. It increases. So here we have an example. If the corporate tax is 25, if you pay 30% on borrowed money or lent money, 30% at the higher tax bracket, and then we're paying roughly 12% on the equity types of tax, we would find that in general, for every dollar you borrow, there is roughly a 6-cent increase in value to the company. Now, one of the challenges with this is, of course, that everybody has a different tax rate, right? Every investor could have a different marginal tax rate. The corporations, this is kind of fixed, but these two numbers vary depending on the investor. So that adds a very complicated relationship between the taxation on financing and investing in these things and the actual impact on value. So using debt is still advantageous, but we're not sure of exactly what the actual benefit is. However, if there's benefit to borrowing more, we should borrow more. So what is the impact of this tax code on the Miller model? Again, the combined federal and state tax is reduced to about 25%. So it didn't significantly affect the tax rate, the personal tax rate, though. So there was a big deduction on the corporate side, but not so much on the personal side. So the top personal rate went from 39 to 35, and of course at the low end, taxes on dividends and capital gains didn't change. At the most, they're roughly around that 20% range, but it could be as low as 15% for lower income investors. So let's think about this overall relationship between the numbers, right? So the tax code significantly reduced T sub C. So now that's much smaller. So this overall amount now is less. It also had some influence on the tax code for shareholders, but very little, right? So again, there was some reduction in this overall amount. This number went down a little bit. They also made some small changes down below, but again, not much. So the net effect is that this amount in this bracket is probably a lot lower than it used to be. Again, this means that what? That debt still adds value, but much less now than before. The one thing that we've left out of this discussion so far has been the concept of financial distress. So at low leverage levels, the tax benefits that we have outweighs the potential bankruptcy costs of going bankrupt, right? So if you have a little bit of debt, there's very little chance you'll go bankrupt. So those potential costs are different. You still get the benefit of the tax, but that's not as high, it's not as great as the potential cost of bankruptcy. Now, as you borrow more and more, if you remember, the formula says the cost is 1 minus TC, right? That doesn't change for a corporation, but now the potential cost of bankruptcy increases. So what we find is that the value of a levered firm is the value of the unlevered plus again, here's our tax shield, T times D, but now we need to subtract the present value of financial distress. And this number grows as we borrow more and more money. So our graph now, here was our our upward sloping curve when we just talked about taxes. We know it's this straight line. But what we now find is at a certain point, the cost, the financial distress costs, start to eat away at the tax shield, so that there is a point somewhere here, there is a maximum point of debt, a maximum point of value determined by the amount of debt that we have. So what we refer to this point is the optimal capital structure. How much debt should a company have? The simple answer is you take on as much debt to maximize the value of the company. In this case, we need more and more debt to get to higher values. But once we get past that point, we've started to deduct value. We need to stop borrowing and stay at that point. So that is, in the nutshell, some very hopefully understandable theories about how much debt managers should take. We know that taxes are important, but we also know that financial stress is important. So those things need to offset each other. Now, unfortunately, we also have more complications, right? We have kind of left out the behavioral part, not just the behavior of investors and what they think, but now we also have to incorporate the behavior of managers. What are they actually thinking about when they're making this decision? See you in the next video.